Well, hi there, and welcome back to another episode of Let's Talk Real Estate Investing. I'm your host, Sharon Vornholt, and I'm so happy you're tuning in today. My guest today is Sam Wilson, and we're going to talk about how real estate investors can scale into bigger assets. And this is a topic that I'm really excited about, so I'm really glad Sam is on here today. Sam is an active investor in self-storage, parking, retail, multifamily apartments, RV parks, and single-family homes, where he's just done so well. He has so many strategies, so I'm sure you're going to find him a really interesting guest. He also hosts the How to Scale Commercial Real Estate podcast, where he interviews real estate experts to give listeners the tips, tools, and tricks to scale their investment portfolio. He has a bachelor's degree in business finance from the University of Memphis, and he holds his real estate license in Tennessee. Sam also has a diverse background in business ownership, building construction, and management. So that's a big resume, Sam. Welcome to the show.
Well, thanks, Sharon. I appreciate that. Thanks for having me on.
So people probably look at this and go, how the heck did he get there? So tell everyone a little bit about how you got started way back when.
Yeah, that's a great question. A lot of mistakes. I mean, that's the only, I learn by doing, and that's it. I have to go out and do it to understand it, which is why I did so poorly in school, was because you had to sit there and you couldn't do it, right? That's not how the rest of life works. You get a free crack at going out and figuring things out. And so each of these assets that I have invested in was by just going out and doing it. A lot of times I did it passively first. So I would get involved with another deal sponsor and say, and that's really how I started getting into commercial real estate in general, was as a passive investor, because I could get a front row seat to how the deals functioned. I could get a front row seat to all the documentation. I could grill them on questions on operations, because it's paying to play in its own right, because you're bringing money to a deal for a deal sponsor. But then that also gives you free pass to go, hey, how does this work? Hey, what are we doing with this? What are we going to do if that happens? And you get to kind of, you get a front row seat to how deals are put together and how an experienced sponsor is thinking. And that kind of helps train your own future investments as well, because then you go, okay, now that I see how they do it, now I just need to replicate it. So that's kind of how I got involved in all of these asset classes. Was first as a passive investor, and then moving into the active side.
It's so interesting. You're the second person in about 3 weeks, 4 weeks that has told me that. Another person told me they actually went and worked for someone for 8 months for free. Free, just hung out, they kept their job, learned the business, said, what can I do? What can I learn? And he said that was the best education he ever got.
Absolutely. I mean, you think about it, you pay to go to college. Why not just go work for somebody else for free? It's no different, except you're not paying to be there.
Exactly. That's a great point. So folks, you need to listen in on that one. That's a great point. Did you start with single family homes, or did you always have a mix?
No, I started with single family homes, and I did a ton of, I again, because I both have shiny object syndrome and get bored easily. I kind of figured out everything I think there was to figure out in single family, which was, I started, my very first acquisition was at the courthouse steps. So I kind of mastered foreclosure purchases, then moved into doing lease options, and then did, all sorts of creative financing, seller carryback, subject twos, did just a variety of stuff inside, and then did a ton of fix and flip on my own long-term rentals. And then I figured out that it was a lot of work, but yet the return profiles with the same amount of work in a commercial asset were far greater. So I could put in the same amount of work and get 10x the return. So I was like, oh, okay. Also, for me, and this is not true for everyone, but for me, it just wasn't as scalable as I would like it to be. I never found an efficient way to get me out of the driver's seat. Whereas on a commercial project, if you're buying a $30 million apartment complex, there's economies of scale where you can bring on property management, where you can bring on, maintenance staff, where you can bring on attorneys and accountants and people like that the asset generates enough revenue to cover those expenses and kind of gets you out of the day-to-day, oh, hey, and you're still managing property. It's still a hands-on deal, but it's different.
Okay. So what, as far as your first commercial venture, what was the, what was number one? Was it apartments?
It was a parking lot,
A
actually.
park, I want to, yes, I want to talk about that. I want to talk about the parking lot.
Yeah, it was a parking lot. It was I love parking. It's funny, I had an investor call this morning with somebody that, because I've got some old legacy YouTube videos out there on parking. And he was watching those videos, which is, a lot of people found it really helpful. It's funny, I still get leads off of that. But they we were talking about parking. Oh, the deal we bought, this was in Houston, Texas, and it was my first syndication. So, I took it down with an experienced partner. That was the other thing I did on that deal. I brought the deal to the partner and said, "Hey, parking. I don't know parking that well. Let's take this down together." And so we did. And that deal, yeah, we put the money together, and parking was beautiful because you're owning, especially surface lots. It's just asphalt. It's asphalt. There's no utilities. There's just very little maintenance. I mean, what's it going to do? Flood? Like, your downside risk is limited. And even if it floods, you go, okay, we're going to wait for the water to go down. It's just asphalt. So your risks are limited. It's also very easy to operate. So you bring in a third party operator, they operate and run the lot for you. And typically what we would always do would be to get a net or a triple net lease from that operator. So we would get an ACH in our bank account once a month, and otherwise our phones never rang, which was
Wow.
beautiful. I'm
Yeah.
kind of I like the idea of mailbox money. And I'm a passive investor in a lot of deals too, and I think that's probably my favorite day of the month is when money gets deposited into your account and you didn't do anything except for write them a check initially and get your money back, which is great. So that was the parking deal, and that was my first. It was a $1.2 million parking lot. It was 19 parking spaces in Houston. So for
Wow.
those of you who
19.
mm-hmm,
Whoa.
19 spaces, 1.2 million bucks. It threw off $150,000 a year, triple net. So our return was just phenomenal. I mean, and that's the cool thing about parking is it's so hyper local. That little lot turned over 3 times a day at $20 a pop. So whatever that comes out to, I don't know, 400, almost 400 times, so I guess 380 times 3. So I mean, it's generating over $1,000 a day in revenue, which is just astounding.
Wow.
So yeah, well, and it was $1,000 a day, 5 days a week. So whatever that is, 220 days a year, or 210 days a year. So your operator's making some money. They're making 60 grand. You're taking 150 home, and it was a great deal.
Wow. I have to tell you, I never once thought about parking lots. That's like very intriguing. Okay.
Very intriguing.
Yeah. Well, let me ask you this. So you started with the parking lot, then what did you move to next?
Yeah, so we did parking there for a year. Then we transitioned when COVID happened. Parking really got crushed, and which it was hyper local before. But if you think about it, think about who was going to ball games, who was going to night and weekend, going out in the town, who was going to events, concerts, all of that stuff just stopped.
Yeah.
And with that, parking also stopped. Even if you owned the parking garage attached to an office building, well, if you had a lease with that office building or whatever it was, even that had to get reworked because no one was and it still hasn't really come back. So it's very hyper local. There are great opportunities still in parking. It just needs to be in a very specific market and a very specific lot. So that being said, I transitioned out of that because what we saw happen was that sellers still wanted their same asking prices, but net operating income had
Yeah.
just fallen off a cliff.
Yeah.
I just got a call from a garage there in Louisville, in your hometown. It was something I was working on here a couple of years ago. We offered them like $11.5 million for it. They called us back and they said, "Hey, you want to take a crack at this garage again? We're ready to sell it." I'm like, "Well, what's your NOI?" "Well, it's non-existent." It's non-existent. And I'm like, "Guys, I can't even offer you a fraction. I can't offer you a quarter of what I offered you before." And they didn't like the sound of that, which I understand, but it's a function of what the net operating income is. So we moved, long answer to your question, Sharon, I'm sorry. Moved then into multifamily. So started did 2 multifamily assets last year. So 2020, we kind of just wrapped up and said, okay, let's re-strategize in our next asset classes. And it took me 8 to 10 months before I did our next deal. So that would have been early of 21. We closed a 246 unit low income housing tax credit property in Winston-Salem, North Carolina. which is great and doing very well. Then did a storage portfolio. So we did a fund of funds in another operator's project, which is where we come in as a capital source. We form our own LLC. All of our investors then invest into that LLC, and that LLC becomes a single limited partner in the operating limited liability company. So we come in as one large investor of a few $1,000,000, and that gives us some leverage with the operator, because then they say, oh, okay, you're going to bring one check and we have one point of contact. That's much easier for a deal sponsor. So, so we get better terms from the sponsor based on how much money we're bringing to the table. So we did a fund of funds and a self-storage portfolio. Last year, I then did a ground up boat and RV storage facility, which boat and RV storage, I think if you look at the, I don't know, I'm just, you asked me, so I'm sorry. If you want me to stop, tell me to stop.
No, you're good. Go ahead.
Okay. Because I can rattle on for far too long. Did a boat and the industry dynamics around the RV industry is incredible, absolutely astounding. So, and we can get into that if you want to, but I'll spare you the stats. So did a boat and RV storage facility, and then did another apartment complex in South Carolina, another 106-unit apartment complex in South Carolina. So kind of got our hands in a variety of things, and those were opportunistic. So it was something, the deals came to me, and I said, yes, I love the deal. The numbers lined up. I mean, there's fighting for multifamily deals is really hard right now. I mean, if anybody's buying multifamily, they know that you're going to be one of probably 12 or 20 people bidding on the project. So
yeah, that's very competitive right now.
Very competitive. So that being said, I don't hunt for those deals, but when they come to me and they make sense, then I certainly want to participate. And I'm at this point very glad we did last year.
Absolutely. So that kind of brings me to the next thought I had. And did you always know you were going to diversify, or did the market itself have a play in how things worked out?
I always have liked the idea of diversification. I like it especially from the passive side of things, because it's obviously far easier to manage as a passive investor. Okay, I'm going to put 50 grand into parking. I'm going to put 50 grand into multifamily, whatever it is. Maybe it's 100. You're dividing up. I like that from a portfolio diversification standpoint. I also like it as an operator, but also as a capital source, because I can then bring a variety of deals to my investor base. And that's fun, because for a couple of reasons, because everybody doesn't want to see multifamily every single day. They may want to be in mobile home parks or in long-term RV parks, so yeah, I've kind of always known that I wanted to, one, again, because I get bored easily, and also because I think there's strategic value in being both asset class and geographically diverse.
Okay. I was talking with another investor yesterday who's in the self-storage space, and we were talking about raising capital. And in general, I like marketing and branding. And I was telling him, look, you're going to have to do some content, because you can't be the best kept secret in town, whether
Right.
it's you want deals to come to you or you want investors to partner with you. Hey, what part would you say your podcast has played in people knowing about you? Therefore, they find you, they bring you deals, they bring you money, whatever.
Both of those. And that's, I would say that's the strongest source that I have, both from an industry credibility standpoint. It does establish you as an industry thought leader, which I think is hyper important.
Yeah.
And via the podcast is how I took down the deals I took down last year, because I have, and some of that also is people that I've known for a while, and it just took a little while for those relationships to bear fruit. But two of those deals, yeah, were strictly because of podcasting, which is where I connect with a sponsor. I'm like, hey, wait, there's synergies here. We are talking the same talk, walking the same walk. I love what you're doing. How can we work together and collaborate? And then, a few months later, hey, here's an amazing deal. Do you want to? And that's a way to scale. If you're thinking about getting into commercial real estate and you want to get your feet wet early, find a way to bring value to a sponsor. What does that mean? Like we were talking about earlier, going to work for free. And that may be not what you have to do, but if there's a way to strategically be on the team, help out with underwriting, help out with capital raising. You got to find, obviously, to stay within the SEC compliance, you have to find and be an actual part of the general partnership and bring something to the table besides capital. That seems like the easiest entrance for a lot of people. Hey, I want to go capital raise. Well, you got to do more than that. But anyway.
Exactly. And this business at each intersection is built on relationships. You can't, there's no way around it. And from my perspective, you never know, like I can meet Sam today and maybe 5 years from today, something will come up and I'll go, okay, Sam is the guy to call, or vice versa. And you touched on that these were some people that you've known for a while, but you didn't match up until later down the road. And that is such an important thing for people to understand. These relationships is the same way with marketing. You may not reap, and networking, you may not reap the rewards of your networking for years. You just don't know when that's going to happen.
Right. That's absolutely true. I think the other thing that I've really started to focus on is intentionally giving without any expectation of a return it's one of those things. It's funny. The more you put out there, the more you give to the people around you. I was at a conference a couple of weeks ago. Passive investors are like that is my gold mine for me, right? I need people. There's two things we need, as you know, Sharon, in real estate: monies and deals. And when you have people that are bringing money to the table, you commonly don't share those with other sponsors, right? It's like, well, Sharon likes to invest with me, and I'm not going to tell you Sharon's name because she's a great source of capital for us, and that's up to you to go find. But I was having breakfast with a passive investor, and he's like, I'm looking for this particular asset class. And I go, hey, wait, I know exactly who you should connect with. Let's connect you guys before the day is over. So I want to make sure that, yes, I know that, okay, whatever his capital might have gone to my project and go to his, but I think it just generates not just goodwill, but it also just, it'll all come back to you in the end. So the more you can give on that front end of connecting with people, the more you can network, the more you can give to that network, I think the faster that will grow for you.
100%, Sam. There is synergy that builds, and I believe that 100%. Let me ask you this. When you are investing in any of those type assets, shouldn't you have a clear strategy up front? Do I want cash flow now, or am I okay if I get it on the back end? How do you feel about that? Do you feel that you need to be clear about that piece, or just dive in?
Yes, you should be clear about that. And what we have seen is it has evolved. The deals, the syndication opportunities in commercial real estate used to have just one class of investor, where it was, hey, you're going to collect some cash flow, and then you'll participate upon with the upon if we on disposition, you'll participate with everybody and make money along the way. A lot of deals that we're putting out now have two classes of investor. So it'll be a class A and a class B. And class A may just get a coupon. They may say, hey, Sharon only wants, she wants the coupon every single month right into her account. So you're going to get, say, a 9% coupon paid to you annually. Not guaranteed, because you still have your senior, debt that has to get covered first, but it will accrue, and you get paid in order of preference from class A would get paid first. Then class B might have like I don't know, let's call it 6% preferred return, right? But then class B shareholders will then participate with the general partners upon disposition. So they may have a 6% pref, but then if the project makes a whole bunch of money when you sell it, then they get to participate in whatever that pro rata share is. Maybe it's 70% to class B and 30% to the general partners. They call that whole setup a waterfall. So that being said, knowing which one you are initially is probably really helpful. At my stage in life, I'm a class B investor in the sense that I want the equity multiple. I don't really care about the cash flow today. I want that, big payday in 3 to 5 years. But if you're like my father-in-law in his 70s at this point, he's like, man, I just want the coupon. Just send me the check every month. Like that's all I'm really worried about. So, knowing who you are will help define some of that strategy. But I think a lot of times you'll see on a lot of these deals that you're going to have that opportunity to kind of pick and or split them up. I think on our deals, if you bring $100,000, you could then go you can set an allocation to Class A and Class B, so you can kind of, get a little bit of both. But, I think it is important, you're right, to know that up front.
It's so interesting because I have to tell you, I've listened to a lot of people talk about this, and you laid that out in a way that people can actually understand, because people find it very confusing. Like, I'm going to put my money in here, but how exactly do I get my money back? Because it's kind of like, we're going to hope the stock market doesn't crash next week. There's a lot of confusion around how all that works.
It really is. And I was reading through a document in which I was a passive investor, and I think there were 12 different steps for when who gets paid when and how much. And I said, man, I understood it, but I go, for the common person that's looking to invest in a syndication, this is ridiculous. And I looked at, I have a good friend of mine here in town who ran a large, he probably had 1,000 homes plus, ran a property management company. And he looked at me and goes, Sam, I don't understand syndications. I'm like,
Yeah.
Wait, so you own tens of millions of dollars in real estate and you don't understand? Like, that means it's too confusing for a guy that's at your level. And this is just, he's just like, this is just too much. So I think there's things that I am openly considering that would make that not just a knowledge hurdle much lower. Like, one of the things I've tossed around, and I haven't done it yet, so don't hold me to this, Sharon, but I've tossed around the idea of just going, hey, what if we just did a 100% return of capital investor? So Sharon puts in 100 grand. And once your 100 grand is returned via distributions, refinance, whatever it is, then we split it down the middle after that. So investors get paid back first, then we split it. I think people would understand that.
I think it, yeah.
And I think what it unfortunately would be a reduced return to the investor, in the sense that we generally have more favorable terms in the waterfall splits to the investors. But I think it's also something where people just go, I get that. That's not complicated.
I think for most people, it's a very complex subject. And like you just said, the 12 steps, nobody wants to have 12 steps. They need it, a few steps, a clear explanation. They just don't want to be bothered learning all the 12 steps that,
Right.
That's my thought, at least.
Then you start throwing in words like internal rate of return, right?
Mm-hmm.
Well, how are you calculating internal? What does that even mean? Well, what is internal rate of return versus annual average return versus return on equity versus equity multiple? And suddenly you got this dizzying soup of acronyms, and it really becomes, because then, and I won't go any further on that, but it's too confusing, I think, for a lot of people.
Yeah. I think if you can find a way to simplify it, it would also help you draw more investors, because I know someone that has $40 million worth of single family homes. And
Right.
he goes, I don't get it. I mean,
Right.
I see the cash flow, a big 6-figure cash flow in my bank account every month. I understand single family homes,
Right.
but I just can't wrap my brain around it. He said, I think I'm a smart guy, but
Right.
this is just really complex. So it's nice to hear somebody else say that, because some of us have felt like we were the slow children in class at times.
Not at all. And it's funny, I just had a deal exit. And it was great because they doubled my money in 18 months. It was a beautiful deal. I had it exit and they sent me the check, or ACH'd it. And I looked at it and I'm like, I want to know how this was broken down, because I know that there was all these, again, 12 steps, which I haven't gone back because I just haven't had the time, but it is too complicated. You're absolutely right.
I want to touch on 3 things that I think people need in order to scale, and have you talk about those. So systems, processes, and staffing. Where do people even start with that, rather than being in the position of, I'm overwhelmed, I'm drowning, what do I need next? How do you prepare to go into like the multifamily class?
That's a great question.
Put you on the spot here, right?
No, that's all. It's wonderful. We'll see if I can answer this in a meaningful way. So systems, I guess it depends on what you think your role will be, or what role you want to take. Multifamily is in particular, and actually think all commercial asset classes, is a team sport. So finding out what role you want to play or can play is probably a first place to start. Obviously you're going to have to get a rudimentary understanding of all aspects of the deal. But if your expertise is acquisitions and and I think by the time you've grown to commercial assets, you've already kind of defined what your strengths or skill sets are. Acquisitions, maybe that's your thing. You love to go out and find deals. You love to send marketers and get them, get people send marketing material and get people on the line and get an LOI signed, a letter of intent signed. Maybe that's your thing. So, you're going to build your systems inside of that. I mean, you're going to need at least 4 seats on the bus, I think, for most commercial real estate deals, which I'm see if I can find those. You're going to have your underwriting, the person that's taking all the numbers in, packaging them all up, saying, does this deal make sense? You're going to need your acquisitions person. You're going to need your investor relations person, which is kind of the role I like to fill, which is where we talk about the deals, we educate our investors, we bring money to the table, we package it up, we work with securities attorneys. And then the last person you're going to need is an asset manager. Even if you own a multifamily project, even if you have the project management company on site, somebody has to manage that project manager or that project management company. Yeah. Property management, if I can speak this morning. The property management company, somebody has to manage them. Somebody has to have their weekly check-ins, look at the expenses. What are we spending money on? Approve, repairs, approve, the renovations and things like that. So there's a lot of pieces different seats that you can fill, and each of those systems inside of those will have their own unique kind of ecosystem. But that's the first thing. And I think that ties into processes as well. So finding what your skills are and then how that interrelates with the other members that you're working with. So, but that's one way to do it. The other way to do it is to kind of do, again, what I've done, which is where I partner with people that have those systems and processes in place. So if you want to scale earlier, I bring some industry contacts to the table. I bring contractors to the table. I have brought capital to the table. I help review the deals. We are on weekly phone calls, bring money as well, but then I let them run the day-to-day operations. So it's a different way to kind of get in the game without having to build out a monster team. I can do what I do, enjoy my side of it, and then let my expert partners run the rest. And that was a question somebody asked me today, like, hey, what happens if you die? I'm like, there's at least 4 of us, at least 4 partners on each of these deals. So, and it's a valid question. And then staffing, I can only speak to what I do on the staffing side of things. So for me, I've got virtual assistants that help me out. I obviously on the marketing front have a full-time marketing person that helps me just kind of get word out there on all my social channels and managing, stuff from lead magnets and downloads, and just kind of, she handles a lot of stuff on the back end that I can't do, but I run pretty light. So yeah, there's a lot of different ways you could really take that down. And as I grow, I will probably bring a lot more of those people in-house, but that's just where I am right now.
I like that answer. I made a conscious decision with my real estate investing business to be set up the way you're set up. I had people before that I called people to feed, and I consciously did not want that. I wanted to use contractors, and not talking about getting cheap contractors. I'm talking about getting the good VAs and the ones that are actually an asset to your company.
Yes.
So I really like that answer. And people think you have to have a really heavy business with your staffing and your people, and you really don't. I think if you've got your systems and your processes, then your 1 or 2 people can run most of the rest of it.
Yep. That's 100% correct. Yeah. And I too, it's taken me, we have had a virtual assistant. She's worked with me for 5 years. And that's probably one of the longest employee relationships I've ever had. And it's not an employee because they're a contractor.
Right.
But it's, that's fantastic. And I'm with you also, because I used to own a business up in Indianapolis, and I think I had 30 employees in that company. And I said, I'm not doing that again.
Nope, not doing that. No way, Jose.
Nope. Been there, done that. Don't need to do it again.
If someone were to decide to follow in your footsteps, what advice would you give them today?
Depends on where they are,
Let's say they're starting with single family rentals. That's all they know. That's all they've done. And they want to begin to scale up.
First thing I would do would be attend conferences where people are doing commercial deals. you're going to learn. I go to 2 conferences every year, and that's about my limit, but I go to the Best Ever conference, which is coming up here in a couple of weeks. And then I do the Intelligent Investors Conference in Los Angeles, which was a few weeks ago. I spend most of my time in the hallway. Actually, I know there's speakers, and I paid a lot of money to go up and sit on stage and be one of the speakers, but I spend 99% of my time out in the hallway just talking to people, because you can learn so much. And that's one of the things I value from podcasting. I learned so much just by having people like you on the show. And I go, oh, right, probate. That's interesting. How does that work? What does that mean? Oh, wait, there's commercial deals that wind up, and that's a mess in probate. So, that's the first thing I would do, would be to go get face-to-face time with people who are doing it, and just be in their network and get to know them, because you will learn. Again, the other thing I would do would be to start signing up for as many newsletters as you can get from the commercial. All of us, or at least most of us, put out a newsletter. I put out a weekly newsletter, and it's read the blogs that they're putting out, educate yourself on that front. And then that'll also help you kind of define what you want your business to look like, what asset classes you find compelling. And once you've figured out, kind of some of those, again, going to systems, process, and staffing, once you've kind of figured out what that looks like, you can start to build out that side of your business. So, okay, I know industry contacts. I've learned a ton from these people. I love this asset class. And then from there, the next thing I would do would be to hire a mentor. I mean, get your checkbook out and compress timelines. And that's something I've spent more on mentors than I ever did on my college education. And I don't regret it one bit. Finding the right mentors. And I say this, I don't endorse the guru, what I call the guru, but no do. So there's so many hustlers out here in the real estate space. Hey, buy my course for 20 grand, do this, do that. And it takes you nowhere. Find someone that is an expert, an absolute expert in the field that you want to invest in, or the asset class you want to invest in. If they are not a mentor, ask them to pay them if you can be. But a lot of people, a lot of your bigger names will be happy to take you under their wing if you write them a nice check. And I've paid to play, certainly, on a couple of occasions, and again, never been disappointed by it. So find a mentor in the space that you can work alongside, because more than likely, when you're doing, 10, 20, $30 million projects, this person will save you at least their investment multiple times over, just by, hey, I'm thinking about this. And they're going to go, that's probably not the best of idea, and here's why. Oh, right. That was going to be expensive. So I don't know. That's the next thing I would do. And from there, I would follow their guidance on how to grow your business.
That's great advice. I know someone that says he invests in coaching and lots of money. He's a high performer, probably in many ways knows more than the coach does. But he says, if I can get one idea and 10x it, that's all I need. One idea and 10x that one idea. So,
yep.
And I know for myself, you will go further and faster and save yourself a lot of grief and lost money if you get a mentor. So Sam, I 100% agree with that. And to Sam's point, you should go over to his website, Bricken Investment Group. He has got a ton of great content over there. I love the way you've broken things down and you just dive into teaching people about what you do. So many people are reluctant to do that if you are looking for, let's say, commercial properties and or money, why would you not want to share with other people? Okay, here are the pieces of it. Let me help you understand how you can give me money easier. I like that philosophy. If they understand it, they can write a check.
Right.
Yeah.
Exactly
so
right.
brickeninvestmentgroup.com. And Sam, thanks so much for coming on the show today. What's the best way for folks to get in touch with you if they want to drop some money your way or learn from you?
Two things. One, love for you to check out my podcast as well. I know you mentioned it early on, but the How to Scale Commercial Real Estate podcast. And then secondly, you can just call me. My cell phone number. It's 901-500-6191. Again, 901-500-6191. Call me, text me. Happy to respond back in any way I possibly can and be of value to you.
Well, thanks again, Sam. I know Sam is, we talked before the show. He's in Memphis. He's got no power still 1 week later. He's hardcore, folks. You can trust him.
Yeah, we're running on the backup generator here for this call today, but it's all good. Thanks for having me on.
Well, thanks for coming. And thanks to all the listeners too for coming out today. And please share this show if you loved it. And I know you did, and leave us a rating and a review on iTunes. It helps people to find us, and I would really appreciate it. So have a wonderful week. I will see you same time, same place next week. Bye for now.